What's going on, y'all? If you guys don't know who I am, my name is Alex. I'm 19 years old. I'm a full-time college student. At the same time, I've been able to make over $20,000 trading profits in the last 2 to 3 months, I'd say. And I did all this through trading ICT concepts, just like you guys. I'm just a 19-year-old kid who was going through YouTube, trying to find a strategy to trade. And I know there's a bunch of different ways to trade ICT. Now, I strongly believe that this is one of the best ways to trade it, which is the unicorn slash ICT silver bullet model. Now, I know when you guys are trying to learn this model. You guys have maybe even tried to watch a couple of videos on this, and maybe even looked it up, tried to go directly to ICT himself. Now, what I want you guys to do right now is to look up an ICT lecture video, scroll through them. Most of them are like over 30, 40, 50 minutes long, and I don't guarantee in every single video that he's going to be talking about trading. Okay, trust me, I've been there as well. I've watched a lot of ICT's videos directly trying to talk about the unicorn and the silver bullet model, and most of the times in his videos, he kind of just strays off and starts rambling and it's just about random shit. And sometimes he just starts defending himself against haters that tell him that he's unprofitable. Whatever the case may be. Right now, there's also a lot of other videos that are just super complicating and just overcomplicate things for no reason. If I can understand it, right? I'm not a 30-year-old man. I'm not a guru. My frontal lobe still hasn't fully developed. I'm 19 years old. If I can understand this shit, so can you. So I'm gonna explain it in a way where you guys, no matter what age you are, 20, 25, 30, 45, over plus, or 16, 15, 14, 13 years old. I don't know if you guys are that young trading at 13 years old, but if you are, good for you. I'm going to explain it in a way that every single person on this app can understand it. Trust me. I'm extremely dumb, so if I can understand it, trust you guys, you can understand as well. So yeah, without further ado, let's just hop straight into it. I don't want to keep this video too long. Yeah, let's get into it. Okay, so I have a little lesson plan planned out for y'all, and how it's gonna go is I'm going to basically go over the four things that are needed in order to enter precisely using a ICT silver bullet model and secure a high win rate. I'm gonna go over all of the different concepts that you need to know that goes into this model extremely simply, and then I'm also gonna go over some examples live backtesting through TradeZilla. So the first thing that we're going to be going over is the actual entry, which is called the unicorn entry. Now, the reason why it's called a unicorn entry, I don't know, but I do think that it's because a unicorn is, I don't know if you guys believe in unicorns or not, but I think it's pretty rare either way. And so the reason why it's kind of called this entry is because an entry like this, a unicorn entry, doesn't show up every single day. It doesn't show up every single moment of time during the charts. But when it does, it's extremely rare. When a unicorn does show up, it's a sign of luck or mythicality, or I don't know, right? And so when a unicorn model actually does show up, I want you guys to be able to identify it, because it's a setup, it's an entry setup that you guys do not want to miss, because it's extremely powerful. And more often than not, price will respect the unicorn model and hit your TP. All luck. Hopefully, you guys hit all of your TPs if you guys are able to identify the unicorn entry. So, what does it consist of? Right, we're gonna go over what it consists of first. So, a fair value gap retest. The first thing that you guys are going to look for during a unicorn entry is there potential for a fair value gap to get retested? Now, hopefully you guys know what a fair value gap is. I want to keep this video, like I said, balanced for people who are just starting out and are intermediate or are experienced and are looking for a better, a clear understanding of ICT concepts. But regardless of that, because I want to go over it with my beginners as well, I'm going to go over super simply what a fair value gap is. So I have a picture right here of a 1 minute fair value gap. Basically, it's a three candle formation, right? A three candle formation that leaves a gap, a price imbalance, which price is going to most likely come back into, refill that balance, rebalance this area, right? This gap that we have, right? One, two, three candle formation. We have a gap where the candles, where the first candle and the last candle do not overlap each other using their wicks. We have a gap that's left open, a sign of imbalance where orders were left unfilled because price moved way too fast from it. And so now price is going to most likely want to rebalance this area, right? Reject off of it and head higher into the opposite direction. That's what a fair value gap does. It holds price. All it does is allows price to rebalance into that gap, holds it most of the times, and price rejects off of it, right? However, that's one of the things that we're going to look for in a unicorn entry to enter off of, right? However, what happens, and how do you know if if a fair value gap is going to hold this area? How do you know if it's a valid gap that you want to enter a long or a short off of? Well, you don't. Now, there's a lot of different concepts that we're going to go over that's going to help us to determine whether it's a valid fair value gap or not. But in times when it doesn't, hold, that can also still be used as a confluence, right? So if a fair value gap gets invalidated, it's going to be called an IFVG, or an inverse fair value gap, right? A fair value gap that gets inversed, a three candle formation that presents a gap where it's usually supposed to hold, right? But sometimes price is going to run through it and inverse that gap. Now, when that happens, for this example, right, we have an inverse fair value gap. We have a 1, 2, 3 candle formation. This fair value gap gets inversed. Candle closes, the body closes below that fair value gap. We inverse it. That's a strong sign that price is bearish. In this scenario, that price is going to run through the fair value gap. We have bearish momentum. So as soon as that happens, what people do is once that body of the candle closes, you can enter off that fair value gap being inverse because we have strong selling momentum. And more often than not, you're going to hit your take profit. Price is going to proceed in the same direction where it inverts that gap. So those are two things that we can use to enter off of a unicorn model, right? However, you have to have it paired with a breaker block. Now, believe it or not, these first two examples I just showed you guys of that fair value gap holding and this inverse fair value gap, this fair value gap getting inversed, in both of the examples, right, I told you guys that we have to pair with a breaker block. Now I'm going to go over what a breaker block is too, so don't worry. I told you guys that we have to pair with a breaker block. In these two examples, I don't know if you guys know what a breaker block is yet, but there are breaker blocks in both of these examples, which is why these worked out so well, because a breaker block paired with a fair value gap is essentially what a unicorn model is. It's a breaker block paired with a fair value gap, which is what makes it so powerful, because it's two ICT concepts that come together and push price in a certain direction. So what is a breaker block, right? So I have it marked out here for you guys. It's that little yellow box right now. What we're essentially looking for in for this, let's take a bearish breaker block example. All you're going to look for in a bearish breaker block, right, is look for a high. So we have a high right here, right? Now next, look for a low. We have a low right here. Now, in a bearish breaker block, we're going to always be looking for a potential higher high first. We're going to look for a higher high. Do we have a higher high here? So we have our first high, right? We have our first initial low. Now, do we have a higher high? Yes, we do. We have a higher high. This candle makes a higher high. Now, to validate this, right, we have three things. We need one last thing in a bearish breaker block to validate this. Do we have a lower low? Okay, yes, we do. We have a lower low right here. Now, it does not matter. You can use the wicks or you can use the bodies. I prefer the bodies. Okay, I prefer as long as the body of the candle, it closes below the previous body, or the body of the candle closes higher than the previous highest body of the candle. That's valid. Okay, it doesn't have to completely go down lower than the wick. Okay, bodies are completely fine. And so we have a first initial high, second initial low, first initial higher high, second initial lower low. Now, once you have all four of those things identified, I know it can be a little bit of a lot, but this is exactly why I want you guys to practice this and come back to this video. Mark out on your chart right now, follow along with me, okay? So once you guys have those four things, you guys are going to look for the candles between the first initial high and the first initial low. So between this high and between this low, which is all of these candles. Right now, you're going to mark out the body of these candles. So you mark out, the outlining candle bodies of the candles within the first initial high, first initial low. You mark that out. Now here is your breaker block. This little box right here, paired with this inverse fair value gap, right, is your breaker block. Now we have an inverse fair value gap here. We also have a fair value gap here. However, we leave this fair value gap untouched, right? And this breaker block barely gets tapped into. Now it does. Maybe you have a limit or sell order marked out here, but sometimes, like I said, price isn't going to retrace into that fair value gap. Price isn't going to retrace into that breaker block. When we have such strong selling power like we do in this example, sometimes we're going to leave this area without it touched. Now, this is exactly why an inverse fair value gap puts you at an advantage with price action like this, is because you can get in a little bit earlier. You can get in before price completely leaves the area. And so I'd recommend, if you guys are confident in your model, if you guys are confident, you guys have experience under your belt, you guys are able to see using discretion or using your experience, if you guys can tell that price is showing strong momentum. The candles are showing volume. You guys can enter if there's a fair value gap that gets inverse, so you guys can have an early entry and potentially save yourself from being edged out of your entry. This is something that I implement more now is inverse fair value gaps, because I know how price looks when we're about to leave an area extremely quickly, and so I'm going to use an inverse fair value gap a lot of the times to get myself a earlier entry. Now that's the pro of it. The cons, however, is you might get a lower fill. So if we, for this example, if we hadn't entered off this inverse fair value gap and maybe waited a little bit for a potential fair value gap retest, price could have retested back here. We could have got a better entry. So there's pros and cons to it. I personally think the pros outweigh the cons when you're entering off of an inverse fair value gap. However, both these work. You can wait for a fair value gap retest as well. Now, speaking of that, we're going to go over this, a fair value gap retest. Right now, same exact thing goes for the bullish example as we had a bearish example. A bearish breaker block and a bullish breaker block, same exact thing. Now, I know this is the first time, so I'm going to walk through it again, but hopefully you guys have a better understanding this time of how to identify a breaker block. Now, like I said, what are we looking for? For a bearish one, we're looking for a high and a low, right? Now, for a bullish one, obviously, we're going to flip everything. We're going to be looking for a low and a high. A first initial low and then a first initial high. We have that here, a low, a high. Now, what do I say? What's the next thing that we need? In a bearish breaker block, we needed a higher high, right? In the bearish breaker block, we needed a higher high. That was the third thing that we look for. Now, the third thing that we look for in a bullish breaker block is a lower low. So, do we have that? Yes, we do. We have a lower low right here in this candle. So we have a low, a high, a lower low. That's three things checked off the checklist. Now, next thing that we need is what? A higher high. Low, high, lower low, higher high. Okay, higher high is presented. Now, same exact thing. Look for the first initial low and first initial high. Low, first initial low, first initial high. Mark out the body of the candles that make up that between that first initial low and first initial high. We mark that out. This is our breaker block. This is our bullish breaker block. Now, guess what? This time, it's paired directly with that 1 minute fair value gap that we were looking at. And we don't really have an inverse fair value gap that happens here. And so a clean one, I guess, that happens here. And so we can wait for a fair value gap to get retested. That fair value gap gets retested in addition to us retesting that breaker block. And then we put our stops. Always, your stops are always going to be at the protected swing low or the protected swing high. Just like this example, we have our stops placed at the protected swing high. In this example, we have the stops placed at our protected swing low. And then price is going to respect that fair value gap, respect that breaker block, and head higher. This is going and then target obviously the internal bias of liquidity or some sort of point of liquidity that you want to target. So yeah, that's basically how you're going to enter off of a unicorn. In terms of the entry specifically, now we're going to go over the three other things that you guys are going to look out for and put the entire model together. Sorry, one last thing before we move on to the other thing I forgot is a tip that I want to give you guys. So some unicorn model entries, right, may seem valid. It may have a valid breaker block, it may have a valid inverse fair value gap, a valid fair value gap on the 1 minute, right? Because that's where we're going to enter. All of these are going to be off the 1 minute. However, I want you guys to always check that we're not going too harshly against the 15-minute draw. I don't want us to be within a 15-minute fair value gap and take a short, because a 15-minute bullish fair value gap is a lot stronger than a 1 minute inverse fair value gap. You know what I mean? So always be aware of where we're at on a higher time frame as well. So this is where higher time frame bias helps. Make sure that we're maybe delivering off of a 1 hour fair value gap. Make sure that maybe we have a 4 hour confluence, a 15-minute confluence, right? So don't be too focused on the 1 minute as well. Yes, there's going to be sometimes setups that seem valid, but always check higher time frame first as well. It's just a tip I want to give you guys before we get into the next steps. All right, y'all. So the next thing we're going to be talking about is the market maker model. We already talked about the unicorn entry, which is the entry model itself. Now the market maker model is going to give us context. It's going to give us a better understanding of bias. Okay, so just like I was saying, you guys can, have a this is kind of what I mean, right? You guys can have a you guys can see, right? You guys can see a valid unicorn model entry here, right? Now, actually, maybe I see one right here, actually, as we speak, right? We have a potential valid unicorn model right here, right? However, you're not going to win the trade. Why? Because of the context, because of the bias, because of where the market actually wants to go on a higher time frame. So this market maker model is going to be the key, the absolute key as to how you're going to figure out when to look for the valid trades, when to look for the valid unicorn and model entries, and when you should stay out or when you should look for the opposite trade. Is what the market maker model is going to tell you guys. Now, this is a bullish example, right? So there's going to be a market maker buy model, which is what we're going to be looking at here, and also a market maker sell model, which is the exact same thing, just flipped a little bit. So before you even get into it, I'm going to go over this picture briefly. This is a picture that's helped me understand the market maker model. Now, this is the absolute perfect market maker buy model, right? I want you guys to screenshot this and use it as a template. Now, I want to warn you guys that when I first started, I was looking for market maker models that were as perfect as this. This is a perfect, absolutely perfect market maker buy model. More oftentimes than not, market maker models are not going to be as perfect as this. Okay, it's going to be a little bit dirtier. It's going to be a little bit messier. However, if you're able to recognize it, you're able to recognize it. No matter how dirty it is, it can still be there. So I want you guys to tag along with me, open up a chart, and make sure you guys are going through the same exact things that I'm going through. Okay, so first off, let's go ahead and review this chart. So on a market maker buy, right? Before you guys can even think about taking long positions on the right side of the curve, you're going to be looking for three predominant things on the left side of the curve. So in the market maker buy model, first thing you're going to look for is an area of original consolidation on the left side. An area where price is going to be where banks are building up orders for us for price to sell off on. So any point of original accumulation is going to look something like this, where price is just moving sideways is the first thing that you're going to look for. Is price moving sideways at all? And the second thing you're going to look for to validate a market maker buy model is, do you see a sell-off after that point of original consolidation? After we create buy-side liquidity, after price accumulates orders, do you see a sell-off without touching that buy-side liquidity? If you do, next thing you're going to look for is phases of redistribution. So for price to redistribute momentarily, right, because we're selling off so quickly right now, for price to redistribute momentarily on the sell side of the curve. Now, this is going to be important during the buy side. So make sure you guys have at least 1 point of redistribution during the sell side of the curve. Okay, so once we finish the sell side of the market maker buy model, price is obviously going to look for us to redistribute or rebalance the buy side liquidity that we had just left up here, right? So some money is going to start accumulating longs. More often times than not, we're going to start moving sideways after dumping how many points that we just dumped from willing sellers, for banks, and for price to kind of rebalance back into the buy side of the sell side curve. Okay, and then like I said, because we have a nice draw up higher, because we have a nice draw of buy side liquidity, that's what banks and prices most likely going to target next. Okay, now during the smart money reversal phase, there's one thing that you guys are also going to look out for is an internal grab on sell side liquidity. Make sure that before we have any sort of a move up, we take out some sort of sell side liquidity, because we need to liquidate sellers, we need to liquidate buyers before we can actually move back up again to the areas of redistribution. Now, once we grab out the point of internal sell side liquidity, you guys can look for, like I said, what I just gave you guys, an entry called the unicorn model, which we just entered off of, right? So this is exactly how you're going to use these two things, right? Like the unicorn entry I just gave you guys is an entry model. Now the second thing I gave you guys is context, so you guys can look for a unicorn entry model here. Now don't panic if you guys can't find a unicorn model entry here. You guys have 2 more chances to find a potential entry. Now on a higher time frame, this is going to be a little bit easier because price is going to be a little bit longer to kind of play out the market maker buy model, right? But if it's not, if you're on a lower time frame as well, you guys can still probably find another entry during the buy leg of the actual market maker buy model. So the second place you guys can potentially find a low risk buy on is the first phase of reaccumulation. So this first phase of reaccumulation is going to most likely match the second stage of the redistribution phase on the sell side. Now I know that was a little bit, maybe I like worded that a little bit confusing, but basically these 2 stages of reaccumulation are going to match the 2 stages of redistribution on the sell side. Okay, more oftentimes than not, if you guys don't believe me, you guys can go back into your charts and look for it yourself. Okay, so if you guys can't find your core model entry here, you guys can try finding an entry on the first phase of reaccumulation or the second stage of reaccumulation. Okay, and so that's basically what a market maker buy model is. You're going to look for original consolidation, redistribution, look for a smart money reversal, try to find an entry during that smart money reversal after you identify sweep and liquidity. If you guys can't, you guys can look for entries on the first and second stage of reaccumulation and target that buy side liquidity that we had first made during that point of original consolidation. Okay, so that's kind of what that chart tells. Now I'm going to give you guys a quick example. Don't worry, I'm gonna like I said, we're gonna backtest real life examples later on during this video, so stick around for that. So first thing here, identify original consolidation. Do we have original consolidation? Yes, we do right here. We have made a point of buy liquidity. Price is moving sideways. We're accumulating orders. Do we have, next thing, a sell-off, redistribution, 1 or 2 phases of redistribution? Yes, we do. We have redistribution phase 1, redistribution phase 2. Okay, now what are we going to look for? A smart money reversal. Do we have some point of, where price is going to start moving sideways again, and then with a stop? And do we have a stop on it? Do we have a grab on sell side liquidity? Yes, we do. We have internal lows here, and we grab sell side liquidity. We have all those things that we checked off. Boom, 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 boom. We checked off all those things that we just talked about. Next thing you're going to do is you're going to look for an entry during that buy curve and target that buy side liquidity high of original consolidation. Okay, it's extremely simple. You guys can identify this as easy as I just did now. Now, some common questions that we're going to go over before we get into the other two concepts is what time frame do I identify it on? Now, that's a common question that I get asked. This is the 1 minute, right? We enter off of the 1 minute, so I prefer if you guys could identify market maker models on the 1 minute. Okay, now 1 to 5 minute time frame is also nice as well. The reason why I don't want you guys to go too high is because we're entering on a such small time frame, right? Bigger market maker models should be used for more content, should be used if you guys want to catch longer moves. Okay, like a 15-minute market maker buy model will play out if you guys are trying to enter on the 1 minute, trying to identifying a 15-minute market maker model and using that as context. There's going to be a lot of noise in order to fill out that market maker model. You know what I'm saying? Like, in order to fill out a 4-hour market maker model, there's going to be a lot of 1 minute candles, a lot of wicks on the 1 hour, a lot of wicks on the 15-minute to actually let that 4-hour market maker model play out. So don't go too far, don't get too high in the time frames, but it doesn't matter. Every single time frame has a market maker model, but the one that's going to benefit us the most is identifying it on a 1 to 5 minute market maker model range. Okay. Now the second question is, does there have to be 2 redistribution phases for price to reach, or as long as is one valid? Like, by redistribution I mean this. Does there have to be 2 phases of redistribution, or can there just be one, and for us to immediately head into our smart money reversal phase? And the answer to that is 1 is fine. 1 is completely fine. As long as there's a moment of rebalance for price to reach back into, it's valid. Now, what I mean by that is, as long as we have at least some point where price stops and reaccumulates orders just briefly, just momentarily, for price to kind of reach back into on the buy side of the curve, that's completely fine. We don't have to have 2. We don't have to have 3. 1 is completely fine as long as we have some sort of rebalance during that sell side of the curve. Okay, so that's kind of how a market maker model is going to work. Let's head into the next 2 topics. Okay, now this next thing is extremely simple to understand, but it can be a little bit hard to do. This really just puts your mental fortitude and just your discipline to test, right? So the next thing that I'm going to talk about is the macro time frames. It's 3 New York AM macros that I think is the most highly probable in terms of price action. Had the highest probability. Cleanest price action is always going to be 15 minutes before the new hourly open and 15 minutes after the new hourly open. Now, the 3 main ones that I want you guys to look at is just in the New York AM. Okay, so the first one is going to be at 9:45 to 10:15, 10:45 to 11:15, 11:45 to 12:15 AM. Okay, now these 3 kind of time frames, I've seen it happen over and over again, and I've gotten, from breaking my rules, even 1 minute trading at 9:43, or even 1 minute after trading at 10:17 has saved me from losses, and sometimes breaking them has, made me take losses that I could have avoided if I just stayed if I had just stayed inside the macro. Okay, it's happened time and time again. Again, if you guys don't believe me, pull up your charts right now, mark out time sessions like that. More often than not, in most cases, the price action between these 3 New York AM macros is going to be 10 times cleaner than price action outside of it. Okay, it's just a highly probable session, and also kind of just helps you give yourself a set of rules of how many times you should be trading and how often you guys should be taking trades. And so these three New York AM macros are when you guys should only be taking trades. And if you guys take a trade within this macro and you guys grab a win, get off. There's no other reason why you guys should be risking your profits. If you guys lose one trade, look for another one within the macros. So if you guys took a trade at like 10:13 a.m. and you guys lost it and it's now 10:17, wait until 10:45 comes around the corner. Okay, now try to take a trade within 10:45, and between 11:15. If you guys get a trade there and you guys win it, get off. Okay. Now if you guys lose the first trade and you guys are looking for another one and say like 11:45, 12:15 a.m. comes and you lose that trade, get off. Okay, that's a clean losing day. You've stuck to all of your rules, which is fine. You're going to lose with this. You're going to lose with this model like you lose with any other model. Okay. But I'm showing you guys right now how to lose the least. And I feel like this model has a pretty high win rate as well. It's a unicorn model, it's the IC silver bullet model. Very probable, just doesn't happen as often. So I'm gonna that's why I'm helping you guys helping you guys in the future identify these things when it does come. Help you guys not miss these entries when it does come. So yeah, these are the three kind of time frames that you guys have to stick to. Okay, I promise you it's gonna take you guys the always the slower route is sometimes the faster route. And that's something that I've been learning as well, is to not force things. And this kind of sticking to these time frames gives you a set of rules. It just calms you down. That it just tells you that opportunities exist. Literally, it doesn't have you don't have to catch every single move that happens. If you guys don't get an opportunity in these three time frames on one day, I promise you it's going to happen the next. Okay, I promise you. I know you guys don't want to wait at all. Trust me, I've done that. Like I've four setups outside the macros up because I just wanted to take a trade that day and I lost. And that sucked. And sometimes I blew accounts because I just traded outside of the macro, bro. And it sucks. If I had just stuck to this 30-minute time frame, I would have saved my entire account. I would have saved a whole bunch of money. So I please strongly recommend, even if you guys don't think that this is a probable, which I don't know why, you guys should genuinely look it up right now in y'all's charts. If you guys don't think anything else of sticking within macros, it at least gives you a template and at least gives you framework for you to stick to something. It gives you framework as to how many trades you guys should be taking and when you guys should be taking trades as well. Because like I said, you guys don't have to catch every single move in the market. Just focus on these three time frames. Master these three time frames. Examine and identify and really go over how price moves usually during these 3 a.m. macros. And I promise you, if you guys are able to master just these three time frames, they get and watch how price moves in these three time frames, it's going to get so much easier. It's literally like looking at one thing happen over and over and over again. You have so many different things to look at. Zoom in on just one thing, right? Just one time frame. Watch how price moves over and over and over and over again within this 30-minute interval. And how can you not get better at identifying things? How can you not get better at discretionary trading and more and intuition within just these 30 minutes of the market? So yeah, I strongly recommend you guys please just stick to these three time frames. Okay, you guys are almost there. Last thing we're going to talk about before we actually get into the examples is an SMT divergence. Now, what is an SMT? So SMT, first off, I'm going to come out and say I use this as a confluence. Not every single one of my trades is going to consist of an SMT. An SMT, all it does is make my setup an A++ setup. Okay, it just adds that extra plus in there. I just spit all over my monitor. I just use as a confluence. Okay, now don't get me wrong, SMTs are extremely powerful. Some people won't straight up trade if they don't see an SMT, right? It's all about preference. But just because there isn't an SMT doesn't mean your trade's not going to head into the correct direction. Okay. So what is an SMT? First off, one SMT is created when two usually correlated pairs like NQ and ES are momentarily uncorrelated. For instance, NQ takes a low while ES fails to do so, or ES takes a low while NQ fails to do so, for a bullish SMT, and then now these two pairs are uncorrelated. Now for a bearish SMT, it'll be the same exact thing. ES or NQ fails to take a high while ES or NQ, while the other pair takes that high. So that would create a bearish SMT. So what does this do? What happens if NQ takes a low while ES fails to do so? Well, this signals buying power and potential reversal. It tells us that buy leg down, that sweep of liquidity was manipulation. And so if we have an SMT at a low, this is a signal for buying power. And I have an example for you guys so you guys can look at it a little more clearer. So on the left side here, we have NASDAQ, and on the right side, we have S&P. And so you guys can see clearly that we have this low protected here on NASDAQ, and we have a low here on ES. Now on ES, we take out that low, we sweep out that low's liquidity. On NQ, we failed to reach that low. Now, what does this do? This signals buying power. This leg down on ES was manipulation to sweep this low. We have a bullish SMT. Once we have that bullish SMT, we get an immediate buy up because, again, that's just a signal for buying power because we have an SMT at the low. Yeah, that's pretty much it. That's a pretty common thing I feel like to understand. And some common questions I'm going to go over is which pair do I choose? How do I know which one is stronger? How do I know, if NQ or ES will be the stronger pair once we put in an SMT? Simple answer, does not matter. Stick with one pair. I stick with the ES, or sorry, NQ. I only trade NQ. Both will react off of the SMT, as you guys can see here from both pairs. Now, on what time frame should we look for an SMT, right? What time frame? It's 1, 5, 10, 15, 1 hour, 4 hour, right? And there's two types of SMTs that you guys could potentially see. So the first thing is like this: we have a lower time frame internal SMT. So we have a lower time frame SMT is going to be the 1 to the 15-minute time frame SMTs, which I think are the best and most favorable for us because we're trading on lower time frames. Now, higher time frame SMTs are going to happen on the 1 hour, 4 hour, and daily. The problem with that is that we're way too small of a time frame to realize the complete effect of a higher time frame SMT. Now, they could play, right? A higher time frame SMT could play out, but usually, so the thing I've seen with higher time frame SMTs is because they're such higher time frames, sometimes they end up getting taken out. You'll see a 4-hour SMT happen, but sometimes that 4-hour high that NQ took while ES hadn't is going to get taken out like 30 minutes later, right? Because it's so higher time frame, price still has so much more room to move, and so you never really know whether price is going to truly react, if that's a truly valid SMT or not. Now that's exactly why I stick with lower time frame, because we can see that happen a lot quicker. Like a 5-minute SMT, if that happens, we can get a lower time frame confluence, like a 1-minute inverse for ride gap from a 5-minute bearish SMT, get a 1-minute bearish inverse for ride gap. Now that SMT is probably valid, right? It's probably a valid SMT. Now I'm not saying higher time frame SMTs are bad. You can use both of them together. I've had times where I've had a 4-hour SMT line up with a 15-minute bearish SMT, line up with a 5-minute bearish SMT. Now I have two SMTs, an internal SMT and an external SMT. Like I said, that adds that extra plus in there. Now we have two SMTs, and it's just an extra confluence for us to use. Now, that third question, I just get this question a lot. So do we have to have these SMTs every single time? No, like I said, SMTs are just purely used as confluence. And yeah, now we covered all 4 of what an ICT silver bullet model should consist of. Now I'm going to walk you guys through some of the trades, the real life trades that I had taken before, and maybe some new examples that we can find. We're going to be back testing it on TradeZella, and we're going to be looking for positions to take perfect ICT silver bullet models. All right, so this first example we're going to be taking a look at actually happened pretty recently on September 22nd on a Monday, and it was a trade that I had taken in real life on my funded account, and we hit for a banger, so I might as well just take you guys through the trade as well. Okay, so the first thing coming into the day before market opens, right, I have 9:30 is when the market opens. I have the first macro AM already marked out. Is you're going to always also mark out points of liquidity to target. So session highs and session lows, we have Asia high here, we have London lows here, London lows, and then Asia highs have already been taken out through London, so London lows are the only valid internal draw that we have right now. So first though, how are we going to determine whether price will take Asia highs, London highs, or London lows? Which one are we, bearish or are we bullish? Now what you're going to look at is on a higher time frame here, right? So through a higher time frame, that's how you're gonna kind of determine it as well. On a higher time frame, we don't have much to go off of though, right? We have a order block here that price is respecting so far, but on a lower time frame, on the 1 to 15-minute time frame, is how I kind of determine that price is going to hit both of these draws today. So on the 15-minute time frame, price or market has not even opened, but if you guys look closely, we have already a unicorn model on the 15-minute time frame. This is a 15-minute fair value gap that price is reacting beautifully off to before market opens. And then you might be asking, well, Alex, where's the breaker block? Well, it's right here. We have a low, right? We have a high, we have a lower low, and then higher high. So mark out, right, the candles between the first initial low and the first initial high. Now if you zoom in, right, mark out the body. These are all all of these 1-minute candles are the bodies of these two candles. So this is the low, this is the high, lower low, higher high, and mark out the body of the 1-minute candles that make up these two 15-minute candles, right? Now there's your breaker block. What does price do? We reach back into this breaker block zone. We reach back into this 15-minute fair value gap, and we react perfectly off to. So price is already bullish, right? Price is showing strong signs of bullishness, strong signs of buying power so far. So knowing that, that's just kind of context as to what price is doing right now, 15 minutes before market open. Now let's go and let's get straight into it and see what price does during market open, which should open here pretty quickly. Let me move this. Okay. Market opens at now. Market is open, but we do not care right now. We're not paying attention to what the market is doing as soon as it opens, because all of that is just noise to us. All we're doing is we're waiting for that macro time frame to start. Okay, so during market open, let me just point out that we had taken London highs. We've taken London highs out, so no longer is that a draw for us to target yet. Okay, so oh, I forgot as well. In addition to that, I forgot to mention to you guys that we also have a potential market maker buy model playing out. This is the same exact example I showed you guys before. We have let me change this to 1 minute. We have original consolidation, redistribution, smart reversal. Now we have potential area for us to take out these highs from the original consolidation area. And so we're also leaning towards a market maker buy model that kind of helps us with our bullish bias. So let's wait until we enter that macro time frame, and boom, there we go. Okay, so we're in the macro time frame now at 9:45 a.m. Here is our macro time frame. And it's perfect. Why? Because we already have something that's playing out for us. We have something that's set up for us beautifully. If you guys can't tell, let me just move this. If you guys can't tell, actually, I want you guys to tell. Identify something for us right now, a potential area of identification. Now this is going to be a little bit of a more aggressive entry. Let me show you guys the 5 minute as well, see if you guys can get anything off of the 5 minute, the 15 minute, everything that you guys want to see. Is there anything that we should be looking out for right now? Let me check ES on the 5 minute. Well, yes, we do, right? Why? Because NQ, we have a 5 minute gap, right? Let's just mark out that 5 minute gap on NQ. 5 minute fair value gap. Now let's go into the 1 minute, right? Because it's the macro, so we can see any potential area for us to take a position off of, a long position off of, because our bias is bullish as soon as we enter the macro. And what do we have here? Well, an inverse fair value gap that we can enter off of, something that I've mentioned before, an early entry before unicorn model can even play out. If you guys are confident, if we're delivering off of, we have all of our bias covered. If we have a strong bias set, if we have a 5 or 15 minute fair value gap that we're delivering off of, right? We're not going against the 5 or 15 minute draw. We're going with the 5 and 15 minute draw, right? So we inverse that fair value gap. And now we're retesting that zone, that inverse fair value gap zone. Now we have a 1 minute fair value gap here, but I doubt we're going to hit it. I don't want price to leave without us tap. If we don't, in the case that we don't tap into this, 1 minute fair value gap, macro has started. We have a strong volume candle inversing this fair value gap. I'm fine with taking a long here, so we're going to go ahead and take a long position. Once we retest that inverse fair value gap, we're going to target Asia high. We're going to go in for 5 micros, buy here. Like I said, our stop loss is going to be at this protected low, delivering out of that 5 minute fair value gap. Our take profit is going to be at the Asia high that we marked out. Perfect market maker buy model. Perfect bias. We should hit for this trade like I did earlier on. Let's just see how it plays out. Immediately react nicely off of that inverse value gap area. Now again, right, we have a validified unicorn model. If you guys wanted to wait for this to happen, you guys could have, right? You guys could have waited for this entire unicorn model to play out. But like I said, if you guys want to take a more aggressive earlier entry in case you guys missed the move earlier on, inverse value gaps are completely okay as well. Now, one thing that I did forget to mention is on this trade, I remember we did not have an SMT, right? But like I said, we have all other three conflicts. We have a market maker buy model, we have a unicorn model, and we have and we're in a macro. So all three of them. And then I mentioned earlier as well that an SMT is used as a confluence. It's not a mandation. So continue this trade, and we should take profit here pretty soon. There we go. Super clean and easy trade. You guys see how easy and how simple it is to identify something like that. Now I'm gonna try and show you guys another example here. Okay, so here's another example that we're going to be taking a look at. First thing, again, what you do is go on a higher time frame, see if we have any sort of, something that'll help us determine our daily bias. On the 4 hour, I love to look at the 4 hour. 4 hour, I feel like, tells me the most because we open up a new 4 hour 10 a.m. candle on NQ during New York AM session. So the 4 hour, we have just swept previous bias of liquidity, which is always a good sign that we have a potential area of reversal, right? And so on the 15-minute, we're also going to mark out, what did we say again? Areas where, we can target points of draw of buy side or sell side liquidity. So on this one, we have a London or pre-market high. We'll just say pre-market high here. However, we did just take out some sort of buy side liquidity, so I find it unlikely if we reach back up to this high, we're probably going to be bullish for the day. But I find it unlikely we're going to reach back into this high because of the fact that we have just swept some sort of buy side liquidity. But we do have very nice draws lower, right? We have a London low here that we can target, London low that we can target, and then we also have Asia lows here. That's relatively equal to that London low. So again, very, very nice draws for us to target lower, right? And if we look on the 1 minute, I'm going to guess that we have, a market maker sell model, potential area for a market maker sell model. This one's actually extremely clean. We have original consolidation, right? If you could take this as original consolidation too, and you could take these as phases of redistribution. But if you want to be safe, you can consider this the first phase of original consolidation, and then redistribution, and then this area after sweeping that high for us to be in a market maker sell model, for this to be our smart money reversal. Okay, so now we have context, we have our bias. Just like that, we have draws to target, and we also have context, a market maker sell model. So today we're going to be leaning bearish. Now market hasn't opened yet. Let's just go ahead and open it, and like I said, we're going to be waiting for the first macro to play out. So that's what happened at market open. And let's see, actually, I remember, we leave this untouched. So whenever we leave a New York open low or a New York open high untouched, that is a strong area, a strong draw, okay? We're more oftentimes than not going to, not London, New York open, going to come back to that draw and take out any point of New York open. New York open high, New York open low. This time there's a New York open low that gets left untouched, and so that's going to be something that we're going to target coming into the macro time frame, because we're bearish, right? So let's move on a little bit farther until we hit our 9:45 a.m. 9:45. Let's just mark it at 9:45 a.m. is going to start here. Okay, that's where 9:45 a.m. is going to start. And right now we're just chopping. There's not much to go off of, right? If we check the 5-minute, there is a 5-minute fair value gap here that we can mark out, right? On the 5-minute, let's just mark this out. 5-minute fair value gap. And let's see if we can respect this as well. So let's go back to the 1 minute. Okay, all right. Let's check the 5-minute. So right now the 5-minute is still being respected, right? Right now, no full candle has closed above this 5-minute fair value gap. And in addition to that, we're in a macro, right? And in addition to that, I'm pretty sure we have an SMT that gets formed here, right? So ES 5-minute is going to look like this, while NQ's 5-minute is going to look like this. Now identify which high do we take on NQ, while ES that we don't. Which one? Well, it's the 9:35 a.m. high, right? So on NQ, the 5-minute SMT is right here. We take out this high on NQ while remaining this 5-minute fair value gap intact, because we don't fully close over this 5-minute fair value gap. While on ES, we fail to take out this high of our 9:35 a.m. high. We're still down here at 9:35. Okay, so now this is a confluence that we have, maybe, right? Maybe we find a unicorn model entry that we can enter off of. Let's see what happens. Let's zoom in onto the 1 minute. And let's see if we can get an entry anywhere. So this is 9:56. Okay. Okay, we take out New York open high. Now we're starting to retrace. Now now we begin to retrace, right? And we have what? Can you guys identify if we have any sort of a position that we can take here? On the 5-minute, we respected this 5-minute gap, right? We respect this 5-minute gap. We broke structure to the down, so we take out New York open. However, keep in mind, we still have London and Asia lows remaining intact. Do we have a unicorn model, a breaker block, a fair value gap to enter off of anywhere here? Yes, we do, right? It's a little bit hard to see. It's a little bit messy, but it's there. Okay, so we have what? A high here, a low that gets formed here, a higher high, and then a lower low. So this becomes our breaker block. These candles within, right, that make up that high, the candles within that first initial high and that first initial low becomes our breaker block. So here is our breaker block. Do we have a fair value gap to go and enter off of? Well, yes, we do. But do we have one that's paired with the breaker block? Yes, right here. We have a fair value gap that we can enter off of paired with this breaker block, right? So We have are we missing anything? Are we missing anything that we need to know of? We have a breaker block. We have a 5-minute for value gap, so we're not go against the 5 15-minute draw. We have a 1 minute for value gap paired with that breaker block. We have an SMT, right? Like I said, 5 15-minute. We're not going against. ES is also looking bearish. 4-hour, we took out that 4-hour high. So is there anything else that we need? We have a market maker sell model. Great draw so low. No. Okay, cool. Let's take this entry. Let's go into 5 once again. Sell here. Stop loss is going to be at the protected high. Take profit is going to be, let's just target these lows here. Let's target London lows here. Draw out our tool here. Stops at this high. TP at London low. And we're going to let it play out. Let's see what happens. Okay, drawing a little bit deeper into that breaker block. That 5-minute fair value gap is still holding, by the way. 5-minute fair value gap still seems to hold. We take out that low again. Breaker block, 5-minute fair value gap held, everything held. And then we're just going to dump. And then we just begin to dump, right? Beautiful, absolutely beautiful. Filling out that market maker sell model as we speak right now, right? And then, like I said, if you guys want to be safe, you guys could have taken profits at this low, profits once we meet that original consolidation point. But if you're like me, if you want to drop your balls, target London lows, target session lows, and let it sit and play out. And just like that, TP gets absolutely smashed, right? So extremely simple, extremely clean. Like, it happens every single time. I just showed you guys a bullish example, I showed you guys a bearish example, and it's like the same thing. I mark out a breaker block, I mark out a fair value gap that gets paired with that breaker block, right? This 1 minute didn't completely hold, right? However, it's an area of entry. Okay, it's an area where we can enter. This 5-minute fair value gap is still holding, stops above this previous high, so we don't get stomped out, and it gives us an area for us to enter that fair value gap, and that's what we do. And that breaker block holds, that 5-minute fair value gap holds. On the 5-minute, we look extremely bearish, rejecting off that 5-minute fair value gap, 15-minute as well, and delivered to those lows. Perfect market maker sell model example as well with the SMT. And then most importantly, we are still in a macro once we enter that trade. And look what happens. We absolutely bang for that trade. So yeah, that's basically the two examples. Hopefully, if you guys didn't understand it, go back to it, rewatch this video. But I just gave you guys two extremely clean models that happened extremely recently. And I promise you, something like this probably happened today as well. So go back into your charts and look for these kind of examples once again. All right, and with that, you guys now have a profitable model on your hands. Hopefully that's exciting. Hopefully it was enjoyable for you guys to learn. I do have one more thing that I want to cover, but I remember that when I was learning models like this, when I was watching YouTube videos of some dude yapping, I'd have the charts pulled up right next to me, and I'd have fun when what he was talking about would play out right in front of me. Like, it gave me confidence, it gave me hope that, wow, this shit actually works and plays out. And so hopefully you guys felt similar to that. But yeah, hopefully this video covered most of what you guys were looking for. If you guys don't, like I said, I have an extra option for this. This is completely optional if you guys just are interested, but I have a premium side of the Discord that I teach everything in depth of, right? So obviously my Discord is completely free. You guys can join the completely free version. We have a community there, talk to each other about trading. Every single market open, it will be pretty active in there. Help each other out, ask questions, right? And then now here's the premium section where I give signals. We have the premium members Discord chat. I give out daily buys, and then here are all of my videos, my psychology videos, the risk management, and then my model videos, and then levels as well, which is something that a couple of y'all have recently been asking me about. And so I have all those videos there as well, and then a bunch of our members actually have made huge progress in the premium side of Discord since joining. So Joseph is one of the people that joined early on, actually, and he was able to secure his first payout this month after being, I remember him coming into the Discord super lost, and talked about some personal problems outside of his life that kind of held him down sometimes. But my boy Joseph is up now, request his first payout. I see him still going crazy on his new his new fundeds and passing his new evals. So That's a nice well done from Joseph. And then we also had Noah, who hit a bunch of bangers with the unicorn model. Um, yeah, as here Noah, and then we had Zoe pass his first evaluations. Like it's just a positive like environment I feel like to be in. Z got his first funded pass ever. Like it's just a nice way to learn more in depth about this model, more in depth about, levels, or just in general, right? And like I said, I give you guys a profitable model. I give you guys all of this, but if you guys aren't there psychologically, if you guys still need help psychologically, that's just something that I can't totally help with because I'm not you right now. I have psychology videos as well to help you guys with that in the premium side if you guys want. But in the end, at the end of the day, it's all up to you guys. Like me as a person, I can't help you guys like directly with that. You know what I mean? So yeah, that's just another option for you guys if you guys want a little bit more of an in-depth breakdown. But other than that, I don't think I have anything else to cover. Like I said, you guys have a profitable model on your hands. If you guys have any more questions, let me know. If you guys want, join the free Discord, talk with the other people, ask them questions as well. Just take advantage of everything. Take advantage of me. Take advantage if, especially if you guys join the premium Discord. You guys are my priority. Like you guys will be the first people I talk to in the morning, daily buys, and then trade recaps as well. Before I post on YouTube, I'll give exclusive trade recap to you guys as well, which is something that I do. You guys will be my priority. Take advantage of me. Take advantage of this Discord. Do anything it takes to better yourself as a trader. At the end of the day, that's all that matters. Okay, so yeah, other than that, I don't have anything much else to talk about. Hopefully you guys learned a lot from this video, and I will be back with the trade recaps pretty soon. I have something cooking up a little bit, and yeah, I will be back with the normal trade recaps pretty soon. Like I said, cooking something up. Hopefully you guys are okay with it. So yeah, I appreciate you guys for watching. As always, God bless. Have a very safe rest of y'all's day. And yeah, I'll see you guys in the next video.